Hello friends, welcome to my channel FinTech Logics. Now in our last video we talked about an overview of supply chain finance. Now a common question that comes to our head is, how is this different from a normal business loans or a business financing? Because in normal business financing also, a supplier as a business can approach a bank and get the funding. Even a manufacturer as a business can approach the bank and get the funding, and so is the case in case of dealer, right? Now what is the thing that makes supply chain financing little different from the business financing? So the basic thing which makes a huge difference in this case is that in case of supply chain financing, the entire unit, that means the entire supply chain, is transparent or looked on by the funding or the lender. So let's say a bank named ABC is well acquainted with manufacturer for some other loans. That means manufacturer is there as a big entity with the bank getting different types of funding. Now in that case, if there are few suppliers of the same manufacturer who are there, and the dealer who are taking the same type of items which are produced or which are utilized by the supplier goods to produce. Let's say OEM is producing a typical car, let's say car brand A. Now for that car brand A supplier is supplying a clutch, let's say clutch A, which is used only for car brand A, and then the car is produced. Dealer takes only those kind of cars and then sells it to the customers. Now in this case, if you see, orally everybody here is tied up by a supply chain, and which in case of supply chain financing would not need all of them to approach your NBFCs and banks separately. Rather, a manufacturer would be already registered as a big entity. The suppliers of those manufacturers would get registered with the bank with the production of similar kind of documents like contract documents, even similar type of purchase orders, and even the dealers also taking sales order of the similar kind. So in this case, the bank knows the entire ecosystem of supply chain, and the finances can be made available with very minimal documentation and with a very much reduction in of your turnaround time, because everybody knows everybody and it's a complete transparent structure. So this is the major difference why supply chain finance has become so much popular in these common days, and which is quite separate from a normal business loans. Because if you think of all these parties approaching bank, so individually all this underwriting has to be done, and it takes a lot of documents, cumbersome process, and also adds onto a lot of turnaround time. This is the major difference between a supply chain financing and an individual business finance. I hope this made some pictures clear actually why supply chain finance we talk about. Thanks a lot for watching my video, viewers.